Welcome everyone to another of our weekly investment manager meetings, and many thanks once again for tuning in. Year to date, developed market equities have significantly outperformed their emerging market counterparts as Asian economies continue to struggle to cover the coronavirus pandemic. But is now the time to rethink your allocation and perhaps diversify throughout emerging markets even further? Well, to give us and his team's take on the situation, I have the absolute pleasure in talking to Osamu Yamagata, manager of the ABRDN Emerging Market Smaller Companies Fund. But before we get into the content, once again, it would be fantastic if you haven't been able to already subscribe to the channel. It really does assist us in making our investment management and financial planning content on a weekly basis. So, straight onto the content. Osamu, many thanks for your time again today. Let's get straight into it. As I mentioned, traditional large cap emerging market equity indices haven't fared very well year to date, lagging developed market counterparts. How have small cap emerging market stocks fared?
Actually, I mean, small caps in emerging markets have fared better. The index is up 19.9%, well, let's just say 20% at the end of August. And obviously that's against the large cap, which was up around 3%. And actually, I mean, the small cap performance isn't really, I would say, just a year-to-date story. I mean, if you take over the last 1 year as well, I mean, it's gone up over 44%. The large cap index around 21%. And even on a 3-year annualized basis, it's around 13% against 10. And I think the 44% really puts fares quite favorably against any index I think you can take, whether it's large cap or small cap. So there is some strong momentum currently within the emerging market small company space.
Now, Aberdeen is renowned for the capability within emerging markets. How do you approach your portfolio construction, and what do you believe made you so successful?
I mean, I guess small caps, by their nature, are less understood by the market. It's highly inefficient, but at the same time, many of these companies sort of reside within the corporate life cycle where you're at the highest stages of growth, but also with the highest execution risk. So the critical measure of generating return comes from focusing on deep stock-specific analysis, as well as a grounded understanding of the market dynamics, since the fellow investor in smaller companies tend to be more local, each with their own market dynamics. In Aberdeen, we've been investing in emerging markets as a company for over 30 years. We have a large experienced team. And we place a lot of emphasis on placing our teams near our companies. So we have offices across Asia, UK, and Brazil to ensure close local presence for our companies that we invest in. Research of smaller companies and allocated resources takes significant commitment from the firm, as and it's a commercial viability aspect. You're capped by liquidity constraints of running a concentrated and highly active portfolio. So it takes a company that has a long-term vision for the asset class. And fortunately, I'm on a company that does that. Now, in order to accumulate alpha across cycles, we have a preference for companies that exhibit both strong quality and growth potential while being cognizant of valuation. We also take a long-term view, limit turnover, and place a lot of emphasis on what it means to be owners of businesses. So we pay a little bit more attention to long-term drivers of value, which include things like corporate culture, governance, and stakeholder relationships, which ultimately means we spend a lot of time on ESG, which is a bit of a buzzword at the moment. But we look at those values in companies, and it's something that we've been doing within our portfolios for a very long time. So we build a portfolio from the bottom up. We focus on stocks with a long time horizon and limiting turnover as much as we can. So it's more of a private equity type approach. And ultimately, we end up with a portfolio that is very high in quality, high in growth, resilient, and less prone to cyclicality. Focusing on that means we deliver a predictable return. profile. We offer very strong downside protection while maintaining performance during periods of strong underlying performance. And we think that's the best way to extract value over cycles in emerging markets. So that's really, the way we invest and, on our portfolio construction.
Yeah. We've already mentioned the outperformance year to date over the last 12 months with regards to small cap emerging markets over large cap counterparts. Can this continue, and how are you positioning the funds into the second half of the year and then into 22 and beyond?
Yeah, I mean, obviously I come from, I am going to be a little bit biased here, but I think I'm personally very confident on the small cap outperformance, and I think there's lots of reasons, but I want to just dial in on maybe 4 factors, which I think is important. Yeah. First is that, as you mentioned at the very beginning, emerging markets are catching up on the vaccine rollout. They are slightly behind. While there's been a delay to the growth rebound that you're seeing in developed markets, we expect a more sustained and strong recovery as developed market growth is plateauing. So we do think there's an environment for emerging markets to do well and to compare favorably. And then the second part, I think large companies have struggled this year, not necessarily to do with the economy per se, but through regulatory pressure in China. That's been a big driver for their underperformance. So mega cap stocks like Alibaba or Tencent or some of the education companies whose value went from very high to zero almost overnight. And I think that's become an increasing discount that's being placed on the large cap market. Now, when you look at the small cap part, because of the size and the type of companies, they are closer to the consumer or perhaps a smaller part of the global supply chain, they don't have that same regulatory risk or pressure that you're starting to see in some of the larger companies. Mm-hmm. So what I think will happen, and we're starting to see happen, is that investors who own regional portfolios or cap strategies, they will increasingly look to allocate more resources down the chain, remove that sort of governance and regulatory risk, and that's going to be a tailwind for smaller companies. Mm-hmm. And then the third point is we still see much better value for the higher growth that we see in the small caps, both in the near term and the medium term. Now, concurrent to this, another powerful driver has been earning estimate revisions upwards. Yeah. And we've seen a higher number come through in the smaller company space than we have in the large company space. Mm-hmm. So I think there is a lot of alpha and returns being generated which are higher and unexpectedly higher in the smaller company space. So again, we talk about sort of rotation or diversification. I guess this is why we're having this conversation today, but we do think that smaller companies will continue to attract more interest as we move through the year and going forwards. Mm-hmm. And then the fourth part, and this is quite important, is that ESG, for better or worse, and it is for the better, is a powerful tailwind that's in the market at the moment. Now, smaller companies have much lower coverage of ESG analysis. If you take the MSCI ESG rating, which is very popular among many buy-side firms, only just over half the index itself is covered by these names, and others have no rating. Now, we do our own work beforehand to come up with our own quality analysis, and we think there is a strong re-rating potential to come. Now, this will bring in thematic investors who are obviously, is a growing part of the allocation pool, and they have a wider market cap funnel, let's say, to invest. So as disclosure analysis improves, and it's something that we're engaging with our companies all the time to improve, we'll start to see an ESG premium starting to build into the portfolios in the smaller company space. And again, that is a powerful tailwind that we've seen in some large cap companies for sure. If you look at Chinese solar companies and all these sort of wonderful names that have re-rated significantly, we do see those sort of tailwinds potential coming through into the smaller company space. Mm-hmm. So I guess we believe that there are strong tailwinds that are quite unique to the small caps that will continue to show outperformance for their asset class going forwards.
Mm-hmm. Just based on what you said there, it does seem to be very buoyant and very positive moving forward. And the interesting part for me, and this is based upon conversations that I've had with various fund managers from various different sectors, is that using broad ESG ratings, you do miss a lot of fantastic companies that aren't rated that can benefit from the awareness as and when it lands. So that ESG premium hasn't been rolled in yet, and that can come up with which leads to further excess returns, which obviously that's what we're all about. Samu, once again, it's been an absolute pleasure talking to you. All I'm going to say is keep the performance going because it's been fantastic. You stay safe, and I'm sure we'll catch up soon.
A pleasure. Thanks. Thank you.